Welcome back. Today I'm going to do a review of Occidental Petroleum, OXY, the company that Warren Buffett has been buying over the past few months and expressed his interest to buy at least 50% of the shares. I'll start from the valuation first, then I'm going to go over some of the key points and problems that I see with the investment. In my next video, I'm going to do a comparative analysis of Occidental Petroleum to Suncor Energy, a company that I've been buying. I'm going to do comparative analysis and comparative valuation. So let's start from the valuation. For valuation purposes, I'm going to be using free cash flow generated by OXY. For the past 3 quarters of 2022, the company has managed to generate well over $3 billion of free cash flow per share. However, for the sake of our review, I'm going to take into account the fact that oil prices have declined recently, also that take into account a potential slowdown in the economy in 2023 and 2024. Also, I'm going to extend this potential decline, which I don't believe is going to materialize in further years, at least not in the oil sector. However, nevertheless, I'm going to extend this decline into the 3 next years. So I'm going to essentially assume that there is going to be no growth in free cash flow over the next 5 years. This can be solved. Cash flow can actually be lower, cash flow can be higher. I'm trying to come up with some sort of average for the next foreseeable future. Obviously, I'm not able to foresee the future. I will assume that OXY will generate $2.7 billion of free cash flow per quarter over the next 5 years. 1, 2, 3, 4, 5. And then the free cash flow will grow at a rate of 4% per year. In my opinion, that's quite a conservative scenario. There is also a second, less pessimistic scenario where I assume a 4% growth over the next 5 years and an 8% growth of free cash flow over the next 5 years. So based on these valuations, in the scenario 1 where the free cash flow doesn't grow over the first 5 years and then growth at just 4% per year over the next 5 years, the net present value, assuming a terminal multiple of 7 and discount rate of 12, our net present value should be around $90 billion. While the current market value of OXY is just $62 billion. So the stock, according to this model, is undervalued by 45%. However, if we assume a growth rate of 4% over the next free cash flow growth of 4% over the next 5 years and 8% over the next 5 years, and we take into consideration similar discount rate and terminal multiple, then the present value of OXY should be $111 billion. So it's undervalued roughly by 80%. Now let's look at some of the things that the company discussed in its 2022 quarterly financial statements. It repaid $9.6 billion of debt, or 34% of the outstanding principal. This is great. Then we repurchased 41.8 million shares. Sounds really, really great. However, this represents over 4% of the outstanding float, so excellent. However, this is just 50% of the truth. Things are not as great as the company make it look in the discussions. They are admitting that they actually simultaneously printed almost the same amount of shares as they repurchased. So in reality, over the past 2 years, the amount of shares in OXY increased. But we'll go over it at a later point. Then quarterly free cash flow of $3.6 billion, so this is great, fantastic. The number may decrease or will almost definitely decrease because oil prices have gone down recently. Okay, so let's look at the share situation. So here are our shares over the quarters from 2021 to 2022. So we started at $947 million of shares, and now we repurchased 41 million, well, almost $42 million or 42 million shares, we end up at 1 billion shares. So how come? So the company is actually misleading, in a way misleading the investors. It is pointing out that it is purchasing its own shares, however, simultaneously it's printing even more shares. So that's, I really don't like it, but anyway, the company performs really well, but and I understand that the management needs to be reimbursed for the great performance, but this better results were achieved in reality by the higher oil prices, not by the management. So let's look at the income statement. On the income statement, things look good. Yes, revenue started to increase because, well, oil prices started to go up, so everything looks good. We are generating income, we are managing our expenses, earnings per share are growing, so nothing, I don't see anything important here. On the balance sheet, current liabilities are in line with current assets, so also great. Long-term debt. Long-term debt has been in reality decreased over the past 2 years by $15 billion. So that's great. That means that the investment is becoming more and more reliable. So book value per share is $20.86. It could have been more, but there are also preferred shares. So these preferred shares are affecting the book value. So it's a kind of lower book value for per common share. Cash flow statement, again, everything is great. The cash flow statement shows that the company has been generating free cash flow each quarter for the past 2 years. Well, that's the almost $3.6 billion of the free cash flow generated for the third quarter. But again, I am assuming that since the prices have gone down, and I'm also assuming that there could be a slowdown in the economy, I'm assuming that the free cash flow may go down to about this level. Again, I'm trying to be somewhat on the conservative side. In any case, the company looks quite undervalued by at least 40%. Maybe even 100, because again I used lower estimates. It also depends on what happens to oil prices when we dive into, or if we dive into a crisis. However, China could be opening, so there are a lot of macro unknowns, but so the company is doing well and shouldn't have any problems going through a crisis and generating more of free cash flow and hopefully distributing that cash flow via tiny dividends, or hopefully repaying this free cash flow through real share repurchases, not the artificial share repurchases that they're telling us about, but they're going to increase their shareholders' capital by really buying the shares and not issuing too much of their own shares simultaneously. So things look great. In my next video, I'm going to compare Occidental Petroleum to Suncor Energy, and in my opinion, actually Suncor Energy looks much better than Occidental Petroleum. It doesn't print the shares, it has better parameters, it may generate slightly less earnings, but it has less debt, and well, it just looks safer and generates more dividends to its shareholders. So if you like the video, please subscribe. Cheers, goodbye.